A gym looks like one of the simplest businesses in America. Rent a room, fill it with treadmills, racks, benches, showers, maybe a studio. Sell memberships, collect the same payment every month. If enough people join, the math seems almost automatic. But now imagine the first location works. Not spectacularly, just well enough that you start asking the dangerous question every successful small business owner eventually asks. Why not open another one? Then a third, then 5, then 50. At some point, the thing you are running stops behaving like a gym. You are no longer mainly choosing equipment, hiring trainers, and trying to keep the locker room clean. You are choosing real estate across multiple markets. You are deciding how much capital to put into each new location. You are building a marketing system that has to fill clubs before the clubs have mature revenue. You are replacing equipment on a schedule. You are creating managers to manage managers. And if you franchise, you are building an entirely different business around other people's capital. So the interesting question is not whether a gym can make money. The interesting question is, what has to happen for one ordinary gym to become a fitness corporation? Start with one location. You find a space in an American suburb or city. You sign a lease. You build out the floor. You buy or finance equipment. You hire a manager, front desk staff, maybe trainers, maybe cleaners, and you start trying to convert local attention into monthly members. From the outside, the attraction is obvious: recurring revenue. Unlike a restaurant where you have to sell another meal every time you want another dollar of revenue, a membership business can bill the same customer again next month. That makes the revenue stream feel predictable. But predictable does not mean safe. The gym still has a cost base that shows up whether Tuesday is crowded or empty. Rent does not care how many people checked in. Payroll does not disappear because January signups were weak. Equipment still needs maintenance. Utilities, software, insurance, cleaning, and local marketing all keep running. And before the first membership payment arrives, the owner has to think about opening capital. There is no single honest number that represents the cost of every American gym because formats and locations vary too much. But a simple hypothetical model can show what the capital question actually means. Imagine, purely for illustration, that an owner sets a $1 million total opening budget. Not because $1 million is an industry average, and not because your gym should cost that amount. It is just a round number for the model. In that hypothetical budget, perhaps $600,000 goes to build-out and equipment, $100,000 to pre-opening occupancy and payroll, $100,000 to launch marketing, and $200,000 stays as working capital runway while memberships build. The exact proportions could be completely different in a real project. The point is that opening capital is not only the equipment people can see. Some of the money has to survive the period before recurring revenue catches up with recurring costs. And there is another complication that does not show up cleanly in a spreadsheet. Capacity is not just square footage, it is time. A gym can look almost empty at 11 in the morning and feel overloaded at 6 in the evening. That means 100 additional members are not automatically 100 units of pure upside. The value of those members depends on when they arrive, what parts of the club they use, and whether the experience remains good enough for people to stay. That is why a healthy gym is not simply the gym with the most members. Lifetime gives us a useful example from the premium end of the market. In the first quarter of 2026, the company said some of its centers were reaching desired utilization and revenue with fewer memberships. In other words, management was explicitly saying that raw membership count was not the only target. Pricing, mix, utilization, and spending inside the club also mattered. That same principle applies to a much smaller owner. If you discount heavily to fill the building, you may create a club that looks busy but produces weak economics. If you price too high for the local market, the facility may be beautiful but underused. If you sign up members who leave quickly, your marketing machine has to keep replacing them. If your peak hours become miserable, the growth that looked good on paper can damage retention. So the first real business you are buying is not a room full of equipment. It is a machine that tries to turn local demand into recurring payments while keeping a large physical cost base under control. And before you even think about location number 2, you need to know whether that machine actually works. This is where gym discussions often become misleading. People ask for the average margin of a gym as if there were one universal answer. There is not. A low-price club, a boutique studio, a luxury athletic resort, and a strength-focused neighborhood gym can all live inside the same industry while having completely different economics. So, instead of pretending there is one magic percentage, use disclosed operators as reference points. Planet Fitness reported that in 2025, its corporate-owned clubs that had been open for more than 12 months produced average unit volumes of about $2 million. The company also reported a four-wall adjusted EBITDA margin of about 42.7% for those mature corporate clubs and about 35.3% after applying the current 7% royalty rate as if those clubs were operating under the franchise structure. Those are Planet Fitness metrics. They are non-GAAP metrics. They are not a promise about what your gym will earn, but they show what a highly standardized, mature unit can look like inside one specific system. Now, compare that with Lifetime. In 2025, Lifetime reported that 72.6% of center revenue came from membership dues and enrollment fees, while 27.4% came from in-center revenue. That is a very different model. The base membership still matters enormously. But once the member is inside the ecosystem, the company can sell more than access to equipment. Personal training, programs, and other in-center spending become meaningful revenue streams. The lesson for the small owner is not to copy either company. The lesson is that before you scale, you need to know exactly what kind of unit you have built. Is your model mostly recurring dues with a lean staff and a low price? Is it a premium experience where each member generates more revenue but also expects much more from the facility? Is personal training a profit center, or does it mainly help retention? How sensitive is the club to rent? How much local marketing do you need to keep membership stable? How much reinvestment will the equipment require? And most importantly, can another manager run this club without you standing inside it every day? Because a first location can succeed for reasons that do not scale. Maybe you personally know half the members. Maybe the landlord gave you unusually favorable terms. Maybe the site happens to sit beside the perfect residential cluster. Maybe you are the best salesperson in the company and you are still taking tours yourself. Those advantages can make the first gym profitable while hiding the fact that there is no repeatable system underneath it. And the second location is where those hidden weaknesses usually start becoming visible. The second club feels like duplication. It is not. It is a new real estate decision, a new construction project, a new local labor market, a new membership ramp, and a new set of fixed commitments. Planet Fitness describes the problem clearly in its own risk disclosures. The company says new clubs begin with higher than normal marketing spending. Operating expenses can also be elevated, especially relative to early monthly revenue. New clubs may not be profitable at first, and their revenue may not follow the historical patterns of existing clubs. That is the part people miss when they look at a mature gym and imagine copying it. A mature club and a new club are financially different objects. The mature club already has a member base. The new club begins with a lease, payroll, equipment, and launch spending before it has the same level of recurring revenue. So the second location creates a cash flow gap. You are spending money today for membership revenue that may take months or longer to build. And if you chose the wrong site, there may be no easy fix. Planet Fitness also warns that if the company or a franchisee gets site selection wrong, the capital invested in developing and building the club may not be recovered. Its filings list the practical bottlenecks: finding suitable sites, competing for those sites, negotiating lease and financing terms, construction costs, supply chain issues, permits and approvals, and hiring qualified employees. Think about what that means for a small owner. Your first gym may have taught you how to operate a gym. Your second gym teaches you that growth is partly a real estate development business. You now need a repeatable way to evaluate trade areas, visibility, parking, local income, competition, rent, build-out cost, and expected membership ramp. And you have to make those decisions before you know the final result. The worst location is not always the one that fails dramatically. Sometimes it is the one that almost works. It opens, it signs members, revenue grows, but rent is too high, acquisition is too expensive, the local market is smaller than expected, and the club never produces enough cash to justify the capital tied up inside it. That kind of location can survive for years while quietly blocking the owner from doing something better with the money. So by location number 2, the business has already changed. You are no longer asking, "Can I run a gym?" You are asking, "Can I repeatedly deploy capital into new sites without destroying the economics that made the first location attractive?" And if you get through the second and third locations, the next bottleneck becomes even more personal. It becomes you. One gym can revolve around an owner. 5 gyms cannot. At one location, you can notice the broken machine yourself. You can hear that a trainer is leaving. You can watch how the front desk sells memberships. You can see whether the bathrooms are clean. You can personally step into almost any problem. At 5 locations, the distance between the owner and the gym floor begins to matter. Now you need managers who can make decisions without calling you every hour. You need reporting that tells you which club is losing members, which club is spending too much on labor, which club has equipment downtime, and which manager is hitting targets without destroying the customer experience. You need purchasing standards. You need hiring standards. You need a process for opening and ramping new locations. You need a way to decide which local decisions can stay local and which decisions must become company-wide. And you need to think about replacement capital, not just growth capital. Planet Fitness offers a useful illustration. Its franchisee-owned clubs are generally required to replace fitness equipment every 5 to 9 years. That rule belongs to Planet Fitness, not to every gym. But the underlying economic truth is universal. Equipment does not last forever. The more clubs you own, the more replacement cycles begin overlapping. At one gym, replacing a group of machines is an occasional project. Across a network, equipment refresh becomes a capital calendar. Planet Fitness itself reported $147.4 million of capital expenditures in its corporate-owned club segment in 2025. Again, that is not the cost of opening one gym. It is what capital deployment can look like once a network becomes large enough. This is the moment many founders discover that scale does not remove complexity. It converts visible complexity into organizational complexity. Instead of personally fixing everything, you build systems that are supposed to prevent problems from reaching you. And that creates a choice. If you want to keep expanding, do you keep raising and spending the money to own every new club yourself? Or do you let other owners put up much of the capital and grow under your brand? That is where franchising enters the story. Franchising can make a gym chain look almost magical from the outside. A brand can add hundreds of locations without the parent company writing the full construction check for every one of them. But what really happens is not that the capital requirement disappears, it moves. Planet Fitness is one of the clearest examples. At the end of 2025, the system had 2,896 clubs. 2,604 were franchisee-owned. 292 were corporate-owned. So the overwhelming majority of the physical locations were being operated by independent owners, not directly by the public company. And for new U.S. franchisees, Planet Fitness's current royalty rate is 7% of monthly dues and annual membership fees. That changes the parent company's economics. If you own the gym directly, you receive the club's revenue and pay the club's operating costs. If a franchisee owns it, the franchisee takes on the local operating business and much of the capital burden, while the franchisor earns according to the franchise agreement and supports the system around the brand. That can accelerate growth, but it also changes what headquarters has to be good at. The parent company now has to recruit and support operators. It has to enforce standards. It has to train. It has to protect the brand. It has to provide marketing systems and technology. It has to make sure a club in one state still feels recognizably like the same business as a club somewhere else. And franchisees still face the same real estate problem we saw earlier. They still need financing. They still need a site. They still negotiate leases. They still face construction costs, permits, staffing, and ramp risk. Planet Fitness explicitly says its growth depends heavily on franchisees being able to finance new development. So, franchising is not a way to escape unit economics. It is a way to build a larger organization around them. If the franchisee cannot earn an acceptable return, the network eventually has a problem, no matter how attractive the royalty stream looks at headquarters. That is why the transition from owner-operated chain to franchise system is so important. The company stops being only an operator of gyms. It becomes an operator of operators. And once that happens, new sources of corporate revenue start appearing that the owner of the original neighborhood gym never had. Look at Planet Fitness at corporate scale, and you can see the transformation in the financial statements. The company reports 3 operating segments: franchising, corporate-owned clubs, and equipment sales to franchisees. In 2025, the franchise segment generated about $468 million of revenue. Corporate-owned clubs generated about $546 million. The equipment segment generated about $310 million. That third business is especially interesting. The original gym owner buys equipment because the gym needs equipment. The scaled franchisor can participate economically in the equipment cycle across the network. Planet Fitness says franchisee-owned clubs are generally required to replace equipment every 5 to 9 years, and equipment revenue represented 23.4% of Planet Fitness's total revenue in 2025. So a giant gym system can begin earning from something that was originally just a cost center for the first club. Now look at the scale of the underlying consumer business. Planet Fitness reported $5.3 billion of system-wide sales in 2025. That number needs an important warning. System-wide sales are not the same thing as Planet Fitness's consolidated GAAP revenue. They include membership dues and annual fees billed by franchisees, which are not recorded as company revenue in the same way as sales from corporate-owned clubs. Of that system-wide total, about $4.7 billion was attributable to franchisee-owned clubs and about $552 million to corporate-owned clubs. That is what scale looks like when the brand becomes much larger than the directly owned asset base. And Planet Fitness is only one model. Lifetime shows another route. In 2025, roughly 72.6% of its center revenue came from membership dues and enrollment fees, while 27.4% came from in-center revenue. So, instead of relying mainly on franchising, a premium operator can increase the economic value of each relationship by selling more inside the facility. These models look different, but they share the same strategic idea. Once the network reaches scale, management asks a different question from the owner of one gym. The one gym owner asks, "How do I make this location profitable?" The corporation asks, "What is the highest value system we can build around this member relationship?" Should growth come from new company-owned locations? Should it come from franchisees? Should revenue per member rise through premium tiers or services? Should equipment, technology, training, or other centralized capabilities become separate economic engines? That is the upside of scale. But scale has a darker property too. It multiplies mistakes. Consider a simple modeled example. This is not an industry average, and it is not a forecast. It is just a way to see the mechanics. Imagine two owners open nearly identical gyms. Owner A chooses a site with manageable rent, launches with realistic marketing, and sees membership build close to plan. The club reaches a point where recurring revenue comfortably covers the physical cost base and leaves room for reinvestment. Owner B signs a more expensive location because the building looks better. The club opens slowly. Marketing has to stay elevated longer. Membership grows, but not quickly enough to absorb the same rent, payroll, and financing commitments. From the street, both businesses can look successful. Both have members, both have equipment, both are open every day. But financially, they are not the same. Now imagine each owner opens 4 more locations. Owner A is multiplying a unit that has already demonstrated acceptable site economics and a repeatable launch process. Owner B is multiplying uncertainty. The problem is not only that one weak club earns less, the weak club also consumes management attention. It may require more marketing. It may absorb cash that was supposed to fund the next opening. And if several clubs are ramping at once, the owner can end up supporting a portfolio of immature locations before the older locations are producing enough cash to carry them. This is exactly why the development warnings in public company filings matter. Planet Fitness says new clubs can begin with higher than normal marketing and operating expenses and may not initially be profitable. It also warns that poor site selection can prevent the operator from recovering the capital invested in developing and building the club. Those are not theoretical risks invented for a business textbook. They are risks the company considers important enough to put in its SEC filings. And even at enormous scale, member growth is not automatic. In May 2026, Planet Fitness Management said the start of the year had been slower than expected from a net member growth perspective. The company said it was sharpening its marketing and reviewing pricing. Think about the implication. This is a system with tens of millions of members, and management is still worrying about acquisition, demand, and pricing. Scale does not graduate you out of the original problem. You still have to persuade people to join and stay. You just do it across a much larger base. That is where an owner can get trapped by the wrong definition of growth. Opening more locations is visible growth. Adding more members is visible growth. But neither one guarantees that the underlying economics are improving. If your new locations require more capital, take longer to ramp, and generate weaker returns, the company can become larger while becoming financially worse. The business may look more impressive from the outside precisely when it is becoming more fragile inside. And when that happens at 10, 50, or 100 locations, the problem is no longer local operations. It becomes capital allocation. At corporate scale, the numbers become difficult to visualize. Lifetime ended 2025 with 189 centers. That same year, it reported about $1.57 billion of center operations expense and about $339 million of rent. Not all center operations expense is fixed. That would be the wrong conclusion. But the numbers show the size of the machine management is responsible for supporting. Every new center adds another location that has to be staffed, maintained, marketed, and integrated into the broader company. Every lease becomes part of a portfolio. Every equipment decision becomes part of a capital plan. Every opening competes with other openings for management attention and financing. Planet Fitness, with a very different model, reported $147.4 million of capital expenditures in its corporate-owned club segment in 2025. So, when a gym business reaches this size, headquarters is not simply an office where executives approve logos and advertising. Headquarters is a capital allocation engine. Management has to decide which markets deserve another club, which locations need reinvestment, which leases still make sense, where marketing dollars should go, how fast the network can expand without weakening operations, and whether growth should be company-owned or financed through franchisees. This is also where data becomes more valuable. At one gym, an experienced owner can know the business intuitively. At hundreds of locations, intuition has to be replaced by systems. Which clubs are growing? Which clubs are losing members? Which trade areas are saturated? Which locations are too crowded at peak time? Which locations have enough revenue but poor cost control? Which new openings are ramping slower than expected? At this scale, a company can make better decisions because it has more information. But it can also make very expensive mistakes because every policy is multiplied across the system. A bad local decision hurts one club. A bad corporate standard can hurt hundreds. And as the company becomes larger, another layer of complexity becomes unavoidable. Rules that were once background details become systems of their own. Suppose you decide franchising is the path. You are no longer only selling gym memberships to consumers, you are also offering a business opportunity to prospective franchise owners. That brings federal franchise rules into the picture. The Federal Trade Commission's franchise rule requires franchisors to provide prospective franchisees with a franchise disclosure document containing 23 specified categories of information. And under the federal rule, the prospective franchisee generally must receive the disclosure document at least 14 days before being asked to sign a binding agreement or pay money to the franchisor or an affiliate. That does not tell you whether a franchise is a good investment. It tells you that once your gym company becomes a franchisor, selling the next location is a regulated process with formal disclosure obligations. And that is only one layer. Gyms are also public-facing physical spaces. The Department of Justice's guidance under Title III of the Americans with Disabilities Act lists gymnasiums and health spas among places of exercise or recreation that can qualify as public accommodations. So, accessibility and non-discrimination are not optional branding ideas. They are operating obligations. State and local rules can add more layers depending on the market, the facility, and the way memberships are sold. The important business point is not to memorize every rule. It is to understand what happens to compliance at scale. One location can sometimes manage obligations with a local lawyer, a contractor, and an attentive owner. A large chain needs processes, documents, training, audits, design standards, legal review. Systems that work even when the founder is nowhere near the building. And by now, the original gym has almost disappeared from the corporate picture. The equipment is still there, members still work out. But the business around them has become far more complex than the thing the customer sees. Now, put the entire journey together. Imagine two companies that begin with one successful gym each. Company A is disciplined. It refuses to treat the first location's success as proof that every site will work. Before opening location 2, it builds a site selection process. It budgets for the fact that new clubs may spend heavily on marketing before membership matures. It watches utilization instead of chasing raw membership at any price. It gives managers clear operating standards. It plans for equipment replacement before the equipment is worn out. And it slows expansion if the new locations are not proving the same economics as the older ones. Company B is aggressive. It sees a profitable first gym and concludes that the only missing ingredient is more gyms. So it signs several leases quickly. It chooses some locations based on visibility rather than economics. It assumes marketing will become cheaper after the brand grows. It opens multiple clubs before the earlier openings are mature. The owner is still personally solving problems because the management system never caught up. Return to that round $1 million opening budget from the beginning. Assume both companies commit $1 million of total opening capital per club. Again, this is not an industry average startup cost. It is only a deliberately simple model. Suppose a mature Company A location eventually produces $250,000 a year of cash before corporate overhead, taxes, debt service, and future equipment replacement. Now, suppose Company B's weaker location produces only $50,000 on the same hypothetical $1 million capital commitment because rent is heavier, the ramp is slower, and marketing stays elevated. Those numbers are invented for the illustration. They are not Planet Fitness numbers, lifetime numbers, or a forecast for a real gym. At one club, the difference is $200,000 a year of modeled cash generation. At 10 equally performing mature clubs, Company A would be producing $2.5 million against $10 million of opening capital, before central overhead and the other exclusions. Company B would be producing $500,000 against the same $10 million of opening capital. At 100 equally performing mature clubs, the simple arithmetic becomes $25 million versus $5 million of annual modeled cash generation on $100 million of opening capital. Nothing about a real chain would be that clean. New clubs would be at different ages, financing structures would differ, overhead would grow, some locations would outperform, some would fail, and capital would need to be reinvested. But that is exactly the point of the model. Scale did not create the difference between Company A and Company B. It multiplied a difference that already existed at the unit level. At one location, the difference between these two companies may be hard to see. At 10 locations, the gap becomes structural. Company A has a portfolio where mature clubs can help finance new ones. Company B has several clubs competing for the same cash. At 100 locations, the difference is no longer just profitability. It is what kind of corporation exists. The disciplined company may choose to franchise some growth, turning a local operating model into a system that other owners can run. Or it may stay company-owned and build a premium model where each center generates more revenue per membership relationship. The aggressive company may discover that the very act of scaling has made the original economics impossible to see. Corporate overhead rises. Weak sites remain open because closing them is expensive. New openings keep demanding capital, and management begins using growth itself as evidence that the strategy is working. This is why mature unit economics matter so much. Planet Fitness's 2025 disclosures show that its corporate-owned clubs open more than 12 months had average unit volumes of about $2 million and a disclosed four-wall adjusted EBITDA margin of about 42.7%, or about 35.3% after applying the current 7% royalty rate. Again, those are Planet Fitness metrics, not an industry promise. But they show the power of a standardized, mature unit inside a system designed to repeat it. Now compare that with the risk language around new clubs. Higher launch marketing, potential early losses, uncertain ramp, site selection risk. Those two realities exist inside the same company. A mature location can be attractive, while a new location is still a risky capital project. The corporation exists to manage the gap between those two states. And there is one more factor that makes the comparison interesting: utilization. Lifetime said in the first quarter of 2026 that some centers can reach desired utilization and revenue with fewer memberships. That matters because it breaks the simplistic idea that the biggest membership count always wins. A well-run network is not necessarily trying to maximize every visible number. It is trying to maximize the economics of the system without damaging the member experience that produces those economics. So, does scale make the owner safer? Sometimes. Scale can diversify local risk. It can spread marketing costs. It can improve purchasing. It can support better technology. It can create a known brand. It can open access to financing. It can build multiple revenue streams around the same customer relationship. But scale also removes excuses. If the unit model is weak, scale exposes it. If the site process is weak, scale repeats it. If management is weak, scale creates distance between the problem and the people who can fix it. If the company confuses member count with economic quality, scale can make that mistake enormous. The real advantage is not size. The real advantage is repeatability. By March 31, 2026, Planet Fitness reported about 21.5 million members and 2,909 clubs. All 15 clubs that opened during the first quarter were franchisee-owned. Lifetime, using a very different model, reported 190 centers and 888,050 total memberships in the first quarter of 2026. Those numbers are date-stamped. They are not being presented here as today's latest count. They are useful because they show how far a physical membership business can scale in two different directions. One path builds a heavily franchised network with royalties, equipment economics, and relatively few directly owned clubs compared with the total system. Another path builds large premium centers and earns meaningful revenue inside the facilities beyond basic dues. Neither model is simply a bigger version of the neighborhood gym. That is the part that matters. At one location, you can still think like a gym owner. You think about members, trainers, equipment, and rent. At scale, those same ingredients become a portfolio. You are allocating capital across real estate. You are managing recurring revenue across huge numbers of billing relationships. You are choosing how much growth to own and how much to franchise. You are replacing equipment on cycles. You are supporting managers or franchisees you may never meet. You are building compliance systems. You are trying to make one member experience repeatable across locations separated by thousands of miles. And every mistake that once belonged to one building can now belong to the whole network. That is when the gym stops being just a gym. The corporation is not created when the logo appears on the 100th building. It is created when the business can no longer depend on one owner's attention and has to turn a good local operation into a repeatable system. So if you ever look at a single crowded gym and wonder how that business becomes a national company, the answer is not simply more members and more locations. The answer is that somewhere between the first club and the 100th, the owner has to rebuild the business into something completely different. And if that system works, the company can become enormous. If it does not, scale only gives the original mistakes more places to hide.